There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, traders of the world, to the Saturday podcast. My name is Steve Vetterl on the mic, trying to bring wisdom, sometimes just dopey comments, and risk management to the trading community. So let's take a look at the funness. So comments from last week, if I may, and I think I'm going to theme this particular discussion Saturday under the guise of don't just pay attention to the headline, do a deeper dive, right? So what's encompassing the news story? Well, primarily if you're equities, forex, commodities, credit, crypto-based trader, I would imagine what is encompassed most, hopefully, of your news-based week is the Federal Reserve's position and possible pivot, right? Which more than likely is off to the table after Friday, you would think, right? But what if I'm wrong? So let's take a deeper dive into the last Friday numbers. So understand that, as I've talked about before, the jobs that were added, this was the non-farm employment change, employment rates. This carries, I don't know, a moderate amount of pivot action off of Federal Reserve because they watch closely wage pressure, right? Wage pressure comes from an amalgamation of things, but it's primarily how many people are getting a job and what kind of pressure it's putting on employers in terms of earnings, either squeezing them up or down, right? So if there's a tight labor force, you'd think wage and earnings pressure would go up, right? But realistically, if you look sort of behind the curtain, as I often talk about, the headlines that create news stories and get people to click, most of them are clickbait, but the ones that take you to any news-based, whether it be financial, on television, on the internet, through different apps, social media, stuff like that, most of what is put out there is just trying to get you to click, right? So they can prove to their advertisers that they have the traffic and they can charge the rates for advertising that they do. But what I always suggest from a risk management standpoint is look under the hood, right? Just like when you go to an automotive mechanic that you think may be reputable, have an idea, which is a tough thing to sort of say on a financial cast, right? But have an idea of what you think's wrong, right? Maybe put it in YouTube, my car has a vibration. Well, what do you think it's coming from? More than likely it's coming from the motor mounts, of which go bad in a lot of cars, right? So you kind of know if you key in your car's manufacturer and you put in what you think's wrong or the process of a motor mount, you see like a bazillion videos on how to replace a motor mount, which connects the engine to the frame and has vibration dampening rubber and or liquid in it. And in some cases it's electrified. So I digress as always, but the point really being here is that you can essentially look past what you think the problem is to what the remedy is and maybe have an idea of at least some ideas for a solution, right? So you heard a lot about the jobs numbers, which I have up on the screen, forexfactory.com. If you've never been to the website, we use this heavily in what we do. for all trading and running our company, but in terms of just news release, these guys are very solid. But in any case, 528K was the actual, which blew away the forecasts. And that makes for a great headline. But if you look under the hood, and keep in mind these are jobs for July, there was a net loss of full-time jobs in July, right? All of the net 520K jobs added were part-time jobs, most of them low-paying service sector jobs. So since the number of people in the workforce keeps falling, most of these part-time jobs went to people in many cases who actually already have another job. So once you hear that news, right, which they're not going to throw headlines out there of 528K, especially if you're a news media outlet that's trying to support the absolute craziness of the current administration, you're not going to put out there a news headline like 528K jobs, but they all went to part-time people who already have a job, so it doesn't matter. Right? And maybe that'll get some clicks, but that's not going to get you the traffic you're looking for, especially if you have an agenda, right? Trying to push a particular narrative. So I always say, forget all that stuff, right? Look at the headline, take it with a grain of salt, have a fair amount of disdain, right? Or I don't believe it, right? Show me, that type of stuff. Show me the money. One of the best lines ever, right? If you've never seen Cuba Gooding Jr.'s Emmy-winning role, was a great line. Show me the money, right? For those of you wondering, what the hell are you talking about, Steve? You can Google Cuba Gooding Jr. In any case, what else I want to say about that? I think that's pretty much it. So what's that mean? What does all this mean? Why does it matter? Well, will the Fed pivot now? That's the key. Will they be pivoting off of their previous stance? Their previous stance, which most market, including yours truly, had been fairly convinced of, almost brainwashed, if you will, just because of the movement of the markets, especially equity markets, over the last, almost 6 months at this point, maybe closer to 5, that, hey, a whole bunch of interest rate increases are coming. Look out. Then 2 weeks ago, hence the huge rally, the market said, hey, what about potentially the Fed pivoting from a totally hawkish stance to a completely dovish stance, or a pivot or a slight shift? I don't know. Who knows which way they're going to go? Who knows what's going to happen? I don't know, right? I don't know where markets are going. I have an idea, or I can sniff out a potential whiff of where I think they're headed. But all I can do is just offer ways to improve your trading by not paying attention to all the nuttiness out there. Do take it with the understanding that you want to look under the hood. So let's take a look at next week's stuff. Obviously, we're coming into the beast of the summer season. Many schools are starting in the next 2 weeks, so that means that at least parents that have younger children, or children in anything underneath 12th grade students, are going to be out of vacation and back in action over the next 2 weeks. So that means that this week's probably it as far as low volumes, right? Typically, volumes don't necessarily just rocket back, talking more about the equity markets, but in many cases it spills over to almost every market. But they should be back in action in a better trading environment, if you will, and probably lots of different stuff over the course of the next 2 weeks, and possibly throughout half of September. So of note, next week, both the core and the month-over-month numbers, as we've been looking at over last 6 months, that inflation has creeped up and reared its ugly head. Here's the forecasts. Many of the numbers have come in higher, right? Prices have come down, which leads us to keep in mind these are what's going on next week. I don't really have a lot to say other than I usually just stay away from red folder events. But daily chart, FinViz. Not sure I showed this last Saturday, I forget. But here it is. Each of these candles represents a single day. I like to look at these in the aggregate across the top. US equities, all different sizes, shapes, colors, right? European equities and over in Asia. And then we have the VIX index, which is a measure of volatility here. Oil and energy space. To keep in mind, again, these are daily charts, right? But what are we seeing since the high of June in most cases, with the exception of nat gas, right? We're seeing they've moved down, and in some cases precipitously. Just note that I think most of the gas transportation, refining, distribution, as well as the actual end station owners, right? Many of which are corporate owned, are much, much less reluctant to reduce prices as they are to raise them. So just remember that. A lot of times it's elevator up, stair step down, which is almost the opposite of what you'd normally say, right? So just keep that in mind as you're looking at that. Most people that seems to be an area of consternation among a lot of people. They're like, well, hey, the prices of gas have just absolutely crashed. I mean, hell, we've been cut by a third since June, but in many cases, have gas prices come down by a third? The answer is no, but they will. Johnny Smith across the street drops it by a cent, and then Billy Bob across the street drops it by 2 cents, right? It's called competition. It's the core of capitalism. Any case, inflation's coming down in energy, equity prices going up, more so depending on the area. Notice the S&P hasn't cracked through an area of support that's big at 4,200 here on the daily. Same thing with the Dow, but don't pay attention to this. NASDAQ has gone above that level. And then you have the small cap market, which is at that level, okay? So NASDAQ's actually coming up against a pretty big test here. I'm not going to get too into this. I'm just saying if you guys are looking to load the boat short, which the inordinate amount of bears out there have loaded short as of last week, trying to envelop, there's a word of the day, all of their subscribers into keeping their subscriptions for, which most cases is a completely waste of money service. But they're trying to call another turn in the market because we've come up against, at least in most of the equity charts domestically, all kinds of fun areas to start shorting again. But as I've often talked about in many, many different casts, that fourth, in some cases, third, fourth, or fifth rip back up to a broad trend line is a much, much more dangerous place to take a position. Your first rip always has your lowest risk. It's called a slingshot that pulls back from either some sort of breakout to a trend line or a particular area from balance it broke out of or some chart pattern. Those pullbacks, the first ones, always your lowest risk entries. So even if you've missed the initial breakout, oftentimes you'll have opportunity to buy the pullback. And it is typically, if you're a How to Make Money Stocks William O'Neill fan, as I am, I have drank the Kool-Aid. It works. It is your lowest risk trade. Right. What else? Gold ripping back up. I think this was just oversold, quite frankly. Copper's creeping back up a little bit. Platinum, same thing. I would say the prices of a lot of commodities, especially basic ones, not necessarily soybean, but looking at corn, we're still in the toilet on pricing. Canola, cotton, wheat, right? We've had a pretty big rip in OJ. Look at lumber, new low. Right? If housing prices were absolutely storming ahead and we were listening to all the realtors on TV from the agencies or the different realtor groups trying to brainwash us into buying houses at the peak, if that was such great demand, why would lumber be crashing? So I always suggest that there's a couple people actually I just started following, by the way, on Twitter. They're pretty decent real estate analysts. They have absolutely nothing to do with any local realtor board, right? They're completely independent of banks, whatever. They work in many cases for just independent research houses, and showing some of the just absolute gluttony of stuff, especially if you're in Austin, Texas, that just hit the market. Gone from just an absolute net need to an absolute gluttony of oversupply in less than 6 months. Huge sea change turn, right? So credit markets, what are they saying? Well, right here, as we thought towards the beginning of June, with all the Fed interest rate increases that were being priced in, we kind of thought this was an overdone move, as I talked a lot about, that rates were just going to go and just rip up. I mean, it's surprising to see that they've pulled up. Although I think with this jobs numbers, once everybody sorts of peels the cover back as to what's actually going on, they will see that as we switch to a weekly chart, we've come back, but in the grand scheme of things, when you're looking at a weekly chart, which gets rid of lots of the noise and chart pricing action, right? We're still down, right? So those bond funds and ones and counts, if you're in bond funds, which I'm not a fan of, at least this year, although I guess we could have been a fan for bond funds at the bottom of the market here, right? They've rallied about a few percent off the bottom. I think probably at some point I'm going to go back down and touch the bottom again on many of these prices. But, as price goes down, yield goes up, right? So it's an inverse relationship. I get probably most of the questions I get surround, well, hey, how does the credit markets or demand or supply for mortgages affect the mortgage market? Well, mortgages are mostly priced off of the 10-year. There's other factors that go into it. Certainly the Fed's overnight lending rate, but then you have the London interbank offer rate, or what they call LIBOR, that factors into this. But best way to look at this is just looking at it from a perspective of a weekly chart. If the price is going down, 30-year mortgage prices are going up, right? So if you want to take a longer look, just click on and again, we're looking at weekly charts. You can look at monthly, but when mortgage prices were their cheapest ever, is when the 10-year bond market prices were up here. So this is where you'd have, the Smith family next door bragging they got a 275 on a fixed year. Will we ever see these prices again? I don't know. I think it's certainly going to take a cooling off in inflation and a considerably more accommodative Fed to get this, or we have a significant, this would require an uncorrelated break of the credit markets trading and almost pricing along with the equity markets, but it would require an uncorrelated break and maybe a huge correction in equities, and finally a flight to safety in the credit markets to maybe push some of these prices back up. But I would only suspect long term, if we're targeting, is to be back in this zone right here, which will bring mortgage rates down. But we can't say that for sure. All right, so enough of the Forex. We're good there. Let's take a look at the currency markets. Dollar is pulled back. I'm actually going to go back. Let's look at the daily chart first. You always want to be cognizant of what you're looking at here. All right. So, the majors. Let's talk about them. So, the dollar peaked. What was that? End of July. Guess we'll jump over to the main chart for that. But just want you guys to see the correlations between the markets. Obviously, as the dollar has pulled back and traded in what I thought would be that zone from the breakout, right, which almost perfectly capped off this dip here, I should say, or put a support in this dip right here, right at that 105. See, that's that cup with handle break point, especially as you have a huge lift through something like that. In many cases, this was other time frame money starting to take us into a different area, a different zone of trading, in this case, higher. Oftentimes, your first steps back against this area is support. See that right here? So Why, when I go to potentially buy stuff from Europe, is the dollar not the dollar when I see pricing conversion? They're still pricing it way up. It's almost like the currencies have almost completely parodied out, but yet I'm still overpaying for all kinds of stuff in relation to currency conversions on websites. Especially since I'm trying to buy a mountain bike that's been trying to buy for like 2 years. And it's a bike that's built in Ireland, and it's just been impossible to get any inventory on this mountain bike. It's called a Nuke Proof. It's made in Ireland, and the bike's still priced at least 20% higher in euro versus dollar conversions. It's crazy. I even sent him an email saying, "Look, I deal with currencies for a living. You guys are blowing my brains out. I'm trying to buy this bike. Help a guy out." They'll probably send an email back saying, "Have you seen our electric bills in Europe? They've gone absolutely off the charts. You're lucky it's only a 20% ripoff, right?" In any case, I digress. See, that's the beauty. Occasionally, you just get some ramblings of, but I try to have all my stories be rooted in risk management. In any case, what do we want to talk about that's insightful? Yes, dollars pulled back. Yes, we've had rallies in other currencies. Yes, that absolutely ridiculous move by the yen. Let's put it in perspective. Nope. Let's put it in perspective. Yup. The ridiculous move by the yen. I still think we're due for a big snapback. You know, it's almost like Armageddon's falling upon the country. And I almost hesitate to say at this point, if you were looking for like a multi-generational hold long, find an ETF that is rooted mostly in the yen, and take a closer look. I'm not really sure it's time to buy just yet, but it's almost like if you put a quarter position on and you were looking to put a full position on at some point, maybe what they call legging into, and this is a strategy a lot of hedge funds use, they'll leg into something, meaning that they'll pick up certain positions knowing that it's so extreme out as this is that they will more than likely be buying it lower. There's always the naysayers out there say, well, this could turn into a catastrophe situation. This could go down precipitously from here. Yes and no. I mean, there's other central banks that have a lot to lose and gain import export wise from where this is right here. So, I mean, there's pain that comes from all countries, corporations, and central banks once one of the majors starts to really get hammered. I mean, like beyond where we are here. The key really is when you're looking for, especially in the case of a monthly chart, you have to see all the way back 2 decades, a little bit more than 2 decades. This is when the data started, and we're already at are damn near close to those all-time lows. It's what's called an extreme out, right? Would be like an example of that in stock land. Nvidia at what, 350 a share, right? It's an extreme out. Yeah, probably was worth in Nvidia's case. It's one of the very few equity. Just because I know the stock structure and its movements exceptionally well, probably the best of all equities. It prices in, regardless of how well they're hitting on all cylinders, it's still going to be priced based upon market's demand for its shares, right? You know, you have many out there that were in crypto saying, well, you know, this is going to $500 a coin if you were a Bitcoin proponent, and they could not see the end of the forest through the fog they were looking at, right? That's a huge risk management thing. It's one of the biggest in terms of one's ability to see through the trees, or as my theme of the weekend is, just look underneath the hood, right? Look under the cover. Do a deeper dive, dig a little more, and do your own research. And I'll probably have to start coming up with some better analogies because everybody knows I'm a motorhead. And we need some better analogies. But at least I stopped using F1 analogies. So let's jump to the system. By the way, for what it's worth, hats off to tradingview.com. These guys have moved up the list. You can do the research on it here, but you can always click on what's new. They just had it show up, which is kind of cool on the right-hand side. But this has become one of the most successful financial websites of all. And the hits that they get each week, it is bananas. Some of the numbers these guys have. Shocking even to me. I've probably should have paid more attention to this group, which surprisingly is based out of Westerville, Ohio, just outside of Cleveland. And yes, I know the area well. It was our tromping ground when I was in school at Xavier, when little Stevie was in finance school as a drunken bum in the mid 90s. But let's take a look at the chart of the S&P. I'm really going to go into this too much, but I want everybody to kind of see. Start off with the daily. All right, so here's our important, what some are referring to as our inflection point, meaning that we rip back up. It's all kinds of, and notice I don't really draw these because I want you guys to be able to picture them in your head. It's far more pertinent to your trading career that you can envision where all of the trend lines are, right? See if you could picture what trend line we're up against right now. I'll give you a hint. You can use this point and this point, or you can use this point and this point and this point. But either way, we're up against arguably longer term channel down lines, those that are believing in late stage slingshots working, of which I'm not. Why? Because most of the market is pricing in some sort of reversal again. It certainly could happen if other time frame players are willing to step in and take this market lower after a ripper of a rally on a potential Fed halt and pivot to a more dovish stance, which nobody knows. We can read through all the tea leaves on this one, and then at the end of the day, we could be surprised. But I can promise you this from just a standpoint of that max pain theory I'm constantly pushing buttons on. Google it. Those loading the boat short right now, max pain in this market is higher. And it's probably somewhere around the 50% retrace of this entire center line. Or I should say a center point. Probably somewhere right in this 4,400 area. I would imagine this is max pain, meaning that if you haven't heard any of my previous discussions on this, max pain essentially is what would surprise the market most? What would barbecue most market players, right? I spend more time thinking about that than I do any of this price action, any of the stuff that is exceptionally known and all priced into the markets. You know, unfortunately, even now where the market profile chart is, but at least from a volume perspective, right, which is this blue grouping of lines over on the left, the point of control is way up at 4,700. So this would be max pain right here. These areas typically, especially if we spend a lot of time trading down here and this line continues to stay where the most volume was at the high, right? This is an aggregate of volume over just the period you're looking at. So essentially the volume that's traded on the S&P just in this last year. Now, as I bring more, watch this, as I condense this, I want you to watch where this red line is. See if it starts to jump. See how it's still way up there, 4,700, right? Yep, now you see that? See how the line jumped down to 4,400 as I brought more data squeezed into the screen from a market profile perspective? We jumped down here to 4,400. That's my first target. This is max pain. Next max pain is 47. Doesn't mean we'd get there. What if Stevie's wrong? We go right back down, right? I could be wrong. Let's take a look at the dollar. We don't have market profile because there's no aggregated volume traded on this. All right. This breakout right here, this whole range really. It's a range of about 50 cents. And then we got to the high of 109 and a quarter-ish. I still would expect us to trade above this 105 area. If you think this holds and you think those are loading the boat short, where would max pain be? Would be right in here. Be right back in this zone. If you did nothing but just put a half-assed effort into, I'm going to go out on a limb. I don't have the stats to back up what I'm about to say, but I'm pretty sure I'm right. If you were to just pay more attention to where you think the market is not going, just based on charts, you probably with some trial and error, some experience, you will be targeting max pain. And remember, markets, hopefully, if it is a developed market that trades with volume on a centralized exchange, and notice I use other markets, not Forex, because it's not all traded on a centralized exchange. It could be highly manipulated by a particular bank among what I like to call the Big 14 globally that support the liquidity to execute Forex trades. But it's not centralized exchange. I think it would be a different environment if all 14 banks could get together. And I'll tell you, for what it's worth, whoever actually built that exchange would be a billionaire in a few years if they could get it right. I know many are trying, but before you can have a centralized exchange, you're going to have to convince 14 of the world's biggest global banks, which I sincerely doubt none of them can get on the same page because they all hate each other. It would be a tough task. It'd be cool because then I would stop complaining about all the manipulation that goes on in Forex. But from the perspective of being of a market profile nature of auction market theory, which is the sandbox I prefer to play, oftentimes I'm asked why do I prefer that, is because it cannot be manipulated. If you are looking at volume that executes on an exchange, it is uneffable with. Think about that. Can't mess with it. And the other thing that's important about aggregated volume is it shows you where all of the big boys are executing. I don't care if it's dark pools. I don't care, all this hidden this and that. At some point, it's going to show up as volume on the exchange, right? So I use the ES as a great example of this, or you can use TLT, which is the big bond ETF in this arena. These are two, along with the spiders, of some of the most traded products on this planet in any market, bar nothing, obviously outside of foreign currency, which trades a lot larger volume. But these are all traded on centralized exchanges, or of the smaller exchanges, it's all reported as a single volume, just like things are on NASDAQ, right? It can be traded off market, but the volume is still reported. Point being is that it has become a Fort Knox of data that can be utilized with a relative amount of safety in terms of the data's solidness, right? So, because I've had more than a few people ask, well, why did it take you sort of like forever, Steve, in your trading career to get into Forex? It just didn't roll into the picture until about maybe 2010. Because at least back then, only the big players that had access, right? Especially in institutional land are the ones that did well in this area. Everybody else, for the most part, it was the absolute wild, wild west, just like crypto is right now. So at some point, I just am more of a believer of if you're going to put huge capital, you need to have obviously low risk, a whole process, a plan, stop losses, the right type of trading algorithm, obviously, or the right type of mental trading aptitude as a manual trader. But outside of that, some of the best supportive data is aggregated volume. It shows in its purest form where the big other time frame players, the OTFers, so mostly just big institutions, right? Where they're willing to play. That gives you a tremendous amount of insight. So if you want to do a bigger, grander project in this arena, I'd encourage you to start trading the futures markets. You can go out to a program called LinSoft. I'm not sure if I've ever shown this before because I think this is going to take a lot of people's heads and blow them off their shoulders. But so LinSoft and the Investor RT, this is Dr. William Lin's company. He's actually a really good guy. He has, along with a whole bunch of others, he's not the only software guy out there, but he has found with Investor RT, it allows you to truly visualize the markets from a volume perspective. And more importantly, it's fed by some of the best in data. Okay, so not that any one's better than the others, but I far prefer in futures trading land is DTNIQ. This is uneffed with data. It's the same data feed along with CQG and Bloomberg that the big hedge fund trading desks use. So I choose to play in the sandbox of this, right? So I've been using Investor RT since about 2006. Stuff's killer, but it is very, very involved. And I've shot umpteen zillions on how to read what's called the footprint of these price action bars. And but there's all kinds of stuff that it does, and I'm not an owner of LinSoft. I'm not paid by Dr. Lin. I don't know. They have a lot of competitors now, but these guys really in the very early days I used to run a lot of webinars for trading and stuff when I was more of a mentor back in the day, before I started running money. And the software was my sort of go-to house to see volume. So when I moved over to the Forex markets, the first thing I said is, well, do we have good quality data and is being aggregated? And everybody's like, what the hell are you talking about? And of course not, it's Forex. I'm like, shit. I mean, that's like that's like the pillars. Here you guys see here, Wall Street's funny. That's like the pillars of my trading style. So everybody's like, well, you just learn to trade off of price action and all kinds of stuff, moving averages, fibs, all that. I'm like, yeah. I mean, I do that now, but we don't have any volume. Well, there's volume. It's reported by Onanda and FXCM and all these other data providers. Yeah, but it's not centralized, and you're praying, right? Which I don't base any kind of millions of trading size on. I don't base it on a prayer that the data is correct, right? You want to see that the data is correct. So anyway, I seem to drone on about this subject because I'm hoping eventually it'll make it into the ears of somebody that will get 14 large banks to agree to a centralized exchange that can be uneffed with. Then I think I'd be a lot more in. Euro, let's take a look at that. All right, so again, FXCM, not putting any of these people in negative lights. I'm, as my dad would say, son, you are ye of little faith. Yes, I am. On aggregated data. Hey, Case. That can spill out just to a smaller degree on the price action, how these candles are formed too, right? So this is why I trust TradingView as much as I trust Investor RT, which I never thought I'd ever say again, because most of these startups, and they're all out there from eSignal to NinjaTrader to, a bazillion other platforms from Thinkorswim and all that. I mean, most of these platforms, is pretty solid. but they weren't built from the ground up on what's the most important. That's quality of data, latency, and reliability of the trading platform, right? Those are the key pillars of that. In the early days, I think all the guys at Ninja Trader got sick of me sending emails with complaints in there because there was just all kinds of bullshit going on with the softwares. It was an add-on to some other plugin, and it was a solid standalone platform back in the day. If you were an institution, you really only had, whatever you built internally, or the Goldman Sachs Ready Plus platform, or Investor RT, which had a crappy trading dome. So then Trading Technologies came out with TT, and they actually developed what's called a dynamic price action ladder. That's the dome many of you have seen in some of my old videos, domes where you actually execute the trades based upon a move in what's called a dynamic order management system. It's set up like a ladder structure. And that to me is always the best. And now the cool thing about TradingView, I don't know if you guys saw this. I know they rerouted it. I'm not sure where it is, but they actually have a trading dome now. It'll show up right in here. See if I can find it. So what did I do with the trading dome? Oh, here it is. No, that's not it. They just moved everything around. What did they do with the dome? It's all kinds of stuff here on the right-hand side. If you guys haven't seen it, you can like message people and follow folks, and idea bulbs of stuff that pops up. It's all kinds of streams you can follow, as you may have seen. Oh, here it is. Yeah, so here's a price ladder. Now, obviously, these markets aren't trading, and quite frankly, I'm showing this on the wrong market. But if I had, let me just X out, go back, go to the ES, and go to our ladder. Oops. For those of you who don't know the ES, it is the E-mini. Now, we don't have this connected to a broker data feed, but if you did, you'd start to see, like, you could place trades above the market below. Let's say it's trading right around 41, 45. You're seeing bid and offers hit, both lifting offers and hitting the bids and all that stuff going on in the dome right here with volumes going up and down. This can be either static or it can be dynamic. Dynamic is owned by TT, so everybody pays them a royalty, right? So this was the sort of big bitch back in the days. TT stuff didn't have the flexibility that Ninja had, and TT would charge a whole bunch of rates, and you had to go through real expensive brokerage firms, data feeds like CQG, which is about $700 a month. But now, if you could just get the guys to build a better dome where you can set limits, and at one point the really good domes we were using, like I could set an order to short 46.75, and then 3 other orders show up, including a stop loss above the market, right? If I was going short. So if I was going long, we're buying, let's say some sort of limit order to hit at 44. Maybe the stop loss sets at 41, 42, and then you have 3 targets that get set to take it out on the top, and you can actually adjust these targets around. It makes for a beautiful way to just be moving orders all over the dome, right? Because you had to be really dynamic with a lot of these orders, as you'd either take profits off a couple of your position pieces, and then essentially you hear in a lot of my old videos, let your runners run, right? So you leave a couple of pieces on the trade that potentially run up or down depending on where you're expecting the market to go. So, all right. So now that I probably thoroughly lost everybody, I digress. Let's take a look at I think I don't really want. I said enough about this stuff for the last few weeks. I'm afraid going into it again. Let's take a look at spot gold. First, here we go. So we broke out Down now, no surprises. We come back up to the area again. This is now the ceiling of potential resistance. I would expect us to probably trade in this range, barring any bad news or any crazy numbers coming out. So forth. Let's take a look at crypto. Since was it the 14th of June I'm showing here? We've actually been building a base. So this is probably one of the longer bases I've seen in a while. Keep in mind it's just a daily chart. And again, all kinds of bitching as far as data when it comes to this stuff because it's Bitstamp, right? So data complaining aside, a whiny person in that area. It's a pretty solid base. Sloppy, but I don't know that you're going to get any perfection in crypto land. I'm not saying this breaks out above it, but if we do break, we've probably got a pretty big move, and easily to the 50% retrace of this entire previous area. It's 30. So this is not me saying buy, right? I still think this is going lower, but long in the tooth since the high of this. I mean, we're real long in the tooth. We're now just a few more months go by, we'll be a full year since the high, which was what, just under 70? Yeah. Now it's been cut way down as we fully have been talking about. Do not go long this the last 6 months. It's one of the other beauties of these casts. A lot of my calls, both right and wrong, are completely timestamped. So if you want to see if Stevie's truly full of crap or not, you can go back and listen to some of the previous casts. But on the really baseline supported, this thing is just above 19. Structurally, this is what you want to see if you're somebody that wants to go long something. And I'm not talking about just the details, or I guess probably just go like this, show you guys. Remember, we try to stick to macro themes here, teaching you guys how to understand the big picture first. Will put you in a far better position to understand what's going on when you start to drill down inside into smaller time frames, right? So, but ideally after a big fall, let's say this is NVIDIA, right? For lack of a better, you want to be an owner, right? Maybe it's longer term. This is the way a lot of portfolio managers think. If they're looking to pick up a position, maybe for a longer term hold, you want to own something that's just gotten absolutely slaughtered off of the high, right? Like a lot of tech stocks have, and albeit some have rallied, right? Rallied back pretty big. I will be the first one to say I'm not on this Celsius rally, but these guys absolutely went storming back. If you don't know what Celsius is, one of the more popular energy drinks among the elite bodybuilder and trainer dudes, sports folk. This is a good pattern. You want this to get killed, test higher lows, right? A lot of people make the widow type position of trying to buy this as a falling dagger, right? I say, hey, the problem with that is that you don't know if this is the bottom or if you're trying to buy right here and you already have much further down to go. You just don't know that at that point, right? You can always say, well, we're up against long-term pricing structure and this support and resistance, and I get it. But in terms of just the asset price falling of whatever you're looking to own with this type of chart, I always say hold out, let it build a base. What it's doing is it's shaking all of the sellers out, right? And ideally at some point you have, and the volumes don't really tell the story here, but ideally at some point you build a base, right? Highs come up against a particular point. Maybe this is a broader cup, which it isn't. It's a W pattern, but this is almost like a triple bottom type pattern. But then it builds a cup. You continue to get doji-based pullbacks with a tighter range. And then once you break potentially the high, volume goes way up. Maybe if you're looking down at the bottom here, maybe the volume comes in one bar here, the next bar here, the next bar, and then it's all the way up as it rips into a new area that usually tells you, at least on this daily chart, that there's institutional money stepping in to purchase. The big boys are loading up. You want to be on that train. You don't want to be standing in front of it, right? This isn't necessarily the best. And I've talked a lot about this over the last 6 months from a volume perspective, showing lots of charts on the ES and S&P for illustration purposes, but essentially pulling back, getting tight. It's what's called a coil, or even a little flag, if you will, and then boom, right? Your buy point is right in here. It's a zone. If you're concerned that, and you want to be an owner long term of this asset, if you're concerned that you think this is a little too early and it's going to go back down and test the bottoming, and that's fine. Put on a quarter position. Wait for it to drop back down to this area. Maybe you're putting on another quarter down here. The point is you're accumulating ownership in an area of maybe some rock solid or generational, there's our word for the day, huh? Generational type support, right? There's just been a bazillion charts that I've shown over the last 2 years to use as examples of this. This is not by any means a perfect pattern of base or consolidation. It's sloppy, right? But in terms of crypto land, it's, you can't really ask for greatness. One of the big things I talk a lot about in terms of being a superstar trader is you have to be comfortable with the concept of ambiguity. What do I mean by that? What I mean is you have to be comfortable with, they're not ringing the bells at the top or the bottom for you to trade. I mean, you're going in based on gut feel, a bunch of research, hopefully some solid technical analysis acumen, right? I mean, you're basically going into a trade with a ton of screen time and experience, right? But ultimately, it's still a very cloudy decision. But if you've seen these patterns over and over again, they typically play themselves out. But the markets have to be with you, right? The markets, I should say all markets, with the exception of any of the majors that are like the dollar, we've been in rally mode as the dollar's pulled back. We've been in rally mode in equities. I mean, you still have to have prevailing headwinds behind you before you make these types of trades. This is not the type of trade that you make. I don't care how good this chart pattern looks. This is not the type of trade that you make if the rest of crypto is selling off, right? If this is a tech stock chart and this, you're buying whatever company. Should use the example of HubSpot, shouldn't I? I've been whining about HubSpot for a year because I want to be an owner, but it's just too much crap going on with this thing. But as you guys can see, this was a phenomenal chart pattern over the last, well, hell. Actually, let's do this as I digress again. We're looking for examples, though. That's the key. Let's go to a weekly. So HubSpot hit the public markets. Yeah, that's right. It was the third quarter of 14. Nobody knew who the hell they were. But those in the media did. These guys have created a platform that has rivaled Salesforce, not for its CRM capabilities, but for the fact that you can plug everything you need to run an entire marketing organization into HubSpot. Email drips, you name it, video production, all that stuff. So this is not an Adobe, but we had really just sensational earnings growth right in this area, right? And obviously this is the beginning of the pandemic, but this chart looks similar to Zoom, not point for point, but people are home, and this thing got caught just in a huge buy. But here was the break right here. This was the launch. So here's your chance right here to get on the boat. So if you're like, well, hell, I missed this thing. It started to lift. And it's another great example about stuff like this. People are like, oh, this is already overpriced. It's $200 a share, right? So if you're thinking small, right, you want, low price stocks, I'd say forget about that. You want good quality chart patterns that are going to break from a solid base and lift, right? So look at this right here. This isn't probably the easiest to see. Let's try this. How's this? Here's a great teaching point. So if you're not watching the screen, put down your phone, stop texting your friends, pay attention to this one. As we break from here, we lift what? 33 points. So you're like, I've already moved 12% past the buy point, which is typically the range you don't want to be in. But look, we came right back down and we almost touched it perfectly. You had another chance to get on this. This was the time to buy. Why? Because one, it broke from a solid base. Two, look at the volume participation that takes place. So that they should actually print this chart off and stick it in some of their market stuff. I probably have at some point in the archives in IBD. They have a really popular cast and whole news briefing system, if you guys didn't know as well. But in any case, buy point somewhere in the area of 05 to 10. You really can't be picky. The point is a pullback. You get on the horse. Look at the big institutional participation that comes in, volume. Right, this is a big Nasdaq traded stock, so I'm sorry, NYSE traded stock. So this is an aggregated volume example here. Look at the lift, tight pullback, consolidation, right? Some sort of test against that level. I know, understand this is the pandemic, so you'd think these things would be going off, but nope. Everybody was looking to do in-house marketing. They're looking to build their own marketing machines instead of paying all those overpriced ass C-suite marketing executives money, right? This is what HubSpot does. It takes over about 6 jobs, and just kept lifting. Solid base lifting, right? So where's the slingshot, Steve? So you broke out here. Here's the get in the slingshot, right? Tight pullback slingshot right here. And then here's another slingshot, right? You're getting a little long in the tooth, obviously. You're paying a lot more than 208 for this thing, right? You're up almost 150 points in this, but look ultimately where it went, right? Where was your get out or take profits? Well, probably a couple of places along the way up here, obviously, but from the perspective of a rollover, right? It's right here. See the increasing volume that take place, and keep in mind these are weekly charts. Each of these candles represents a full week. I'm just trying to get the noise out of how this move took. But this would have shown itself in a little more detail if you drill down into a daily chart. But essentially it breaks out again, and then you have a rollover where you have almost an island reversal at the top. Not quite that. It's a little sloppy for that, but you have a move back down and then it rips right back up. And then not only does you have an outside day, meaning that it opens and completely covers the entire top, the bottom, and then it finishes somewhere now the bottom of this. This is your signal right here to get out of most of the position. Finish the week with a doji, right? So you'd think after a huge lift, what are we at the top? I forget. 850, 856, something like that. We pull all the way back to 727. Pretty good pullback if you're like a fund manager, right? And you're like, yeah, I got a bunch of extra cash. I'd really like to add some to my HubSpot position. It's getting a little long in the tooth, right? There's obviously a bunch of stuff going on. The whole pandemic was shifting in December of last year. And then you have this doji place out. And then you're like, oh, this is an indecision week. What the hell? More likely it's going to get out next week. Yup. Held at some long-term moving average points and then just absolutely crashed through this, right? Now, people are like, oh, where's your first slingshot short, Steve? Yeah, that's probably something you want to go to a daily chart to see. But from a weekly perspective, you're just trading. Here's your slingshot right here. So we just have way oversold, and it's just pukage in the stock. This is for everybody. This is what I call the get everybody that's in margin out of the leverage, right? You'll have a rip back. These are the buyers down here not recognizing this, saying, "Oh, what's up, spot? They're killing it," and they were. And then you rip back. Here's your short point right here. Options were probably exceptionally expensive at this point, but the puts contracts were much cheaper. I actually bought some puts on this and wrote it down a little ways. They actually did quite nice for us, but I'd rather be an owner than a seller, right? It's much more difficult shorting markets. That's why a lot of short-based only hedge funds like a Kinnico Associates just really don't exist to a large degree. It's much harder as a large pool investor to be shorting markets than it is, because typically markets, at least of an equity nature, go down a quarter of the time and up 3/4 of the time. And that quarter of the time it goes down is typically an elevator down, like you're seeing here, whereas it's a stair step up. It's the opposite of what happens to some of the stuff I was talking about in the beginning of the presentation. So I'm not going to belabor the point, just trying to show you guys lots of examples of where you can see the risk building, where you can mitigate risk. Hopefully it's been helpful. Everybody have a great trading week. My name is Steve Vetterl, off the mic.